It is my pleasure to welcome you all to this Impact Masterclass. I am Neha Gupta. I'm sorry. Yeah. Sorry, I'm Neha Gupta, co-founder of ByteEdge, an AI-based platform for upskilling of professional workforce. I was formerly the director at Aspire Circle, and I'm your MC today for this enriching masterclass on impact measurement and management, principles, standards, and frameworks. As you may know, Aspire was founded in 2007 and is the largest impact collaborative in India today, with over 400 CXOs engaged to help catalyze an Indian impact economy. Last year, Aspire launched impact assessments and ratings initiatives for corporates, funds, nonprofits, and CSR programs. It is my privilege to play a short video introducing India's first homegrown impact rating and certification system. Thank you. Well, as you all know, investors and corporations around the world are in consensus around the idea the journey to solving global challenges is graded and have converged around three categories of investing: responsible or ESG, sustainable, and impact investing. Collectively, as per the GSIA, this impact continuum has attracted $59 trillion in 2020, which is almost half of the global professionally managed assets. Aspire Impact, with its impact assessments, is committed to ensuring impact transparent through standardized impact ratings, which subsume all ESG and sustainability ratings and certifications to support the entrepreneurs and investors in their impact journey. In November 2020, Aspire launched IFP, the Impact Future Project, which is a unique thought leadership platform. IFP brings together over 200 business, investment, and nonprofit leaders to generate investment ideas and unlock private capital. A special welcome to all our Aspire Fellows, governors and elders, IFP leaders, co-chairs, knowledge partners, industry partners, and Aspire staff. After enriching masterclasses with Sir Ronald Cohen, Professor Robert Eccles, Professor Dwight Hopkins, and Kathy Kirk in 2021, we are kickstarting the 2022 masterclasses today with Neil Gregory. Neil is the Chief Thought Leadership Officer of the International Finance Corporation. And to introduce the conversation, I would like to invite Amit Bhatia. Amit is the founder and CEO of Aspire, formerly the inaugural CEO of the Global Steering Group for Impact Investment and the founding CEO of India's Impact Investors Council. Amit, over to you.
Thank you, and welcome, Neil, and welcome all. Friends, it's a pleasure and an honor to host Neil Gregory today. I had I had a chance to meet Neil while I was in my GSG several years ago, and one of the things on my mind was that it will be wonderful to introduce him to our Indian colleagues and to kind of hear his thoughts. And today we finally have that opportunity. I'll quickly give you a very short introduction, but you're going to hear from him in a minute. Neil is the Chief Thought Leadership Officer at IFC, where he's had a checkered career for over 2 decades, holding several strategy, general management positions, working in South Asia, China, Africa, and Caribbean. You'll be surprised or not so surprised. He has an MA in economics from Cambridge, an MSc from Oxford, and an MBA from Georgetown as well. He's currently teaching at John Hopkins School of Advanced International Studies. So he brings together the academic world and the world of practice in as beautiful a way as anyone could. And if anyone can demystify this world, the impact economy that is, playing out right now, it is Neil. So it's a real pleasure, Neil, to have you with us. I think I want to hand the mic over to you, and I think it'll be wonderful for our audience just to kick off, getting to know you a little bit better in your own words. And then obviously we'll look forward to hearing a little bit about you, how you see the world, evolving in this world of responsible, sustainable impact investing. And I'm sure, as you already know, there are tons of questions this audience has for you, and we'll try and pack as much in the next 55 minutes. So Neil, welcome, and over to you.
Great, it's Neha. Thank you for the welcome and the invitation to meet with you today. And it's always a pleasure, particularly to talk to Indian audiences. I spent many years working on IFC's investment and advisory programs in the South Asia region. So I've always enjoyed engaging with Indian business audiences. So I look forward to a lively discussion today. Thanks also for the introduction on my background, just to say a little bit more about how I came to be doing what I'm doing today. So I joined IFC over 25 years ago, and at that time, IFC was very much seen as part of the World Bank and part of the world of publicly owned financial institutions investing for development. And that was what brought me to IFC, was the motivation to use private investments and private enterprise as another way in which you can address poverty and social environmental progress. And so I've spent many years working on investment and advisory programs in different parts of the world, including South Asia. But I think in more recent years, what's been interesting is that it's not just international financial institutions, public financial institutions like IFC, which think about the impact and invest with a motivation for impact. But you've seen growing numbers of private investors starting to think about the environmental and social impact of their investments. And they think about this in different ways, and we'll get into some of that in today's discussion. But we realized that there was increasing convergence between the work that we do and the way we think about managing an investment portfolio for impact, and the growing interest of a number of private investors who were doing the same things. And so the turning point, I think, came in 2015, which was the year when the global community established the Paris climate change goals and the sustainable development goals to be achieved by 2030. And as there were meetings in Paris and Addis Ababa that year to set those goals, there was a lot of discussion about how are we going to mobilize the finance for all the investments needed to achieve those goals. And there was a realization that you couldn't invest enough just by relying on the public sector, and that you needed to mobilize private capital alongside the public sector to achieve these important global goals. And so the increasing interest in learning from the experience of IFC, having over 60 years experience of investing for impact. And so that's when I created the thought leadership group at IFC, was to allow us to have this continuous engagement where we take what we have learned in our business and our investments and our advisory work and share that with the wider community so that we can all learn how better to invest for impact. And so that work then led us to an engagement with the impact investing industry, which was still, I think, at a stage where there was a lot of confusion. The words impact and sustainable and responsible were being used in almost interchangeable ways. And so a lot of what I've been working on in the past 8 or 9 years has been helping the impact investing industry bring some transparency and discipline and clarity to what it means to manage an investment portfolio for impact. And we'll get into more of that over the next few minutes as well. So let me start just with a few slides. I'm not going to spend a lot of time presenting because I really look forward to hearing your questions and getting into a dialogue, but just to sort of frame the discussion a bit, because I think there's still, in many cases, confusion between different approaches to sustainability. So if we go to the next slide, Amit, an easy way to think about this is that traditional investors are in that grey circle on the left-hand side. They don't care about anything except the financial returns. And that, for many years, was how, particularly, I think, professional asset managers felt that their fiduciary duty was just to earn the best return for their clients and that they shouldn't be thinking about environmental and social issues. But over time, we've realized that there are 3 other ways that investors think about environmental and social impact. One, which is probably the most widely held, is that most investors want to avoid bad things happening as a result of their investments. They want to avoid environmental and social damage. And so they may use various strategies to screen out certain types of investments or to run environmental, social, and governance risk assessments. And that's really become quite mainstream today, that approach of avoiding harm. Some people want to go beyond that and say, I want to invest in companies which are improving the world. I want to invest in things which are beneficial to the world. And there's a lot of funds, particularly in public markets, which offer portfolios in clean energy or microfinance or other types of activity, healthcare, education, where companies are clearly doing good things and providing goods and services that the world needs. But there are some investors for whom that's not enough, but they actually say, I want to actually make a difference with my investments. I want to choose investments where my capital is actually contributing to achieving environmental and social progress. So that means going beyond just saying, I'm holding shares in a company that's doing good, but saying, my investing in a company is helping it do more good than it would have otherwise. And we call those investors contributing to impact. And it's that last category, which is what we would call impact investing. So the avoid type of investing is what we'd call ESG investing. The benefits that we call thematic investing, and the contributing to solutions is what we call impact investing. So if we go to the next slide, the question then always comes, well, is there a trade-off between financial returns and achieving impact? And I think in the early days of impact investing, a lot of it was focused on small social enterprises and early stage investments, which are always highly risky and it's difficult to make a good return out of. And so there was a concern that you had to sacrifice financial performance for impact. But as the industry has grown and matured, many funds have found it quite possible to invest and find good financial opportunities which also have clear and measurable impact. And that's been IFC's experience. And we look back over 30 years of our equity and debt portfolios, we can see that we've actually outperformed market benchmarks in our equity and loan portfolio performance while managing that portfolio for impact. So it's not easy. It's challenging and requires good investment discipline as well as good impact measurement, but it can be done. So we don't think there's a necessary trade-off. But the other point I want to show on this slide is that investors can choose where they want to be on the spectrum of how much financial return they want to seek. So we've moved from a world in which people made money in their investment portfolio and then gave money away in their philanthropic portfolio. Now people realize that there's a range of ways you can use your capital in between. You don't have to either go for a full financial return or go for pure grant giving. You can be much more flexible, and you can blend different types of capital to meet the needs of different situations. So we like to think of impact investing as having different types of return depending on what the investor chooses, where the investor chooses to be in this spectrum. So let's go to the next slide. So just to give you a sort of the order of magnitude of how large these different types of investing really are, and I'm afraid I haven't drawn these circles to scale, so don't be to try to interpret the size of the circles, but this is just to give you a sense of orders of magnitude. So the biggest circle, total global financial assets, is something like $250 trillion. And of that, around 100 trillion is now being managed with some kind of ESG risk management approach. So about $100 trillion is managed according to the UN principles of responsible investment, which is the most widely used framework. So that means that we've really gone a long way to mainstreaming this idea that you should avoid environmental, social, governance risks and avoid doing harm in your investment portfolio. And then if you go to the smaller circles, the amount that we see that is being invested with intent for impact is a much smaller amount. It's around $2.3 trillion. So really only about 1% of global assets under management. So we think it's still a niche market, but one which has a lot of potential to grow. And then the smaller circle is that within that 2.3 trillion, not everybody yet has all the systems in place to actually measure and report on the impacts. So the group of investors that really have got all the systems in place is somewhat smaller. We think it's about $600 billion. So these small circles are a small part of the global capital markets, but they're growing rapidly, and we think there's a lot of room to expand. Some people, and you've heard earlier from people like Ronnie Cohen, some people would argue that all investment will be impact investment one day. I'm not sure I take that view. I think there's room in capital markets for people to have all different types of investment objectives. But based on our assessment of market demand, we think it could certainly grow to 10 times the size it is today. And if you could grow it by that much, that would provide enough capital to meet the needs to finance the Sustainable Development Goals and the climate change goals. So we don't have to turn the entire financial markets into impact investments, but we do need to scale up from where we are today. So I think we'll just cover two more slides. So let's skip over the next one, Amit, in the interest of time. And this one, I just wanted to show my definition of impact investing, just again to be very clear before we get into the discussion. For me, there are three things which differentiate impact investing from other types of sustainable or ESG investing. The first is that the investor has an intent to have impact, so it's part of the investment strategy. Secondly, that they choose their investments in order to make a contribution to impact. So that means in most cases they're investing in private equity, private debt, or other forms of investment where you're actually putting new capital into a company to help it grow, rather than just buying shares in publicly listed companies. And then finally, that you measure and report on the impact just as you would on the financial performance of your portfolio. And then let's go to the next slide, which will be my last one. And so I talked earlier about helping to bring transparency and clarity to the discipline of impact investing. And so what we did 3 years ago was bring together a wide range of both private impact investors and development finance institutions like ourselves, and agree that what are the common disciplines that we all follow in managing our investment portfolio in order to integrate the impact dimension alongside the financial dimension in all our investment decisions. And this results in the 8 principles which you can see here, which span everything from investment strategy and origination through portfolio all the way to exit. And then we added a 9th principle, which said, for the sake of bringing clarity to the market, we should ask investors to commit to following these principles and to publish an annual disclosure statement explaining how their management systems align with these principles, and moreover to arrange for regular independent verification, so they have a third party confirm that they are actually following these 9 principles. So having done this, we've attracted over 150 investors to adopt the principles, who manage nearly $500 billion in capital. So we've gone a long way, I think, to creating a market standard, which enables investors to have confidence that if they allocate capital to investment funds and institutions which are managing their capital according to these principles, that their money will be invested for impact in a disciplined and transparent way. So let me pause there, Amit, and open up to questions and discussion.
Thank you.
Thank you, Neil. Thank you. So I'll invite questions now from the audience, and you can type in your questions in the chat box to me, Amit, or Ravi, and we will put these out as far as to the extent possible. So Neil, the first question for you is from Shashank Avasthi. Shashank is the co-founder of Vishesh and India advisor at Grey Ghost Ventures. So Shashank, your question.
Thanks so much, Neha. It's such a pleasure to be here. Thank you, Neil. It's a pleasure to meet you. I just wanted to take on from something that Neha said, and then you followed up about the spectrum between social returns and financial returns. As more and more LPs start talking about wanting to get social impact from the money that they're committing, there are portfolio companies that are worrying about the social impact tag influencing their ability to raise flow on capital, right? So this is a bit of a challenge for the GPs, because on one end, there is this clarity of ask, and on the other hand, there's the hesitation from potential investee companies. How do return first and impact-oriented firms in US, Europe, how are they handling this conundrum?
Yeah, thank you for the question. So I think we've clarified in recent years that impact investors aren't limited to investing in enterprises which are identified as social enterprises or necessarily share the impact objective. I think what is important is that the impact investor at the level of the fund manager identifies companies for whom their achieving business success is aligned with achieving positive social or environmental impact. And that's been the way we've always invested at IFC. We've invested in a wide range of commercial companies where, based on our due diligence, we're convinced that there's good alignment between their business success and achieving impact. So that widens the universe of companies you can invest in, and it means that the companies you invest in shouldn't feel that there's any concern about their being labeled as a different type of company. I think there was even a concern until a few years ago at the level of the fund managers, of the GPs, that many were comfortable with using the ESG label, but maybe not the impact label, because they felt that might deter some investors who felt that they would not be pursuing full commercial returns if they were using the impact label. But I think we've seen that really change in the last 2 or 3 years, as investors have got more comfortable with the concept of investing for impact, And I've learned from experience that there are many impact funds which have offered good commercial returns. I think now that impact label is losing that sense that it means that it will deliver lesser returns. And so you're seeing more fund managers now being willing to use that impact label.
Thank you, Neil, and thanks, Shashank. Wish you safe travels. Well, our next question to you, Neil, is from Nupur Gaba. Nupur is the Director Operations at CareerWell. Nupur, over to you.
Thanks, Neha. Hi, Neil. It's a pleasure to be here. So I have a very simple question. We're a very fast-growing and profitable edtech company, number one in government test prep services, focused on semi-urban and rural areas. We just published our inaugural impact report and are currently in the market to raise $15 million as our Series A investment. We find widespread confusion around distinction between ESG, sustainability, and impact amongst investors. So what are the key differences when investors use these terms, number one? And do you believe that this continuum from ESG to sustainability to impact represents distinct business or investor behaviors and strategies?
Thanks, and congratulations on your fundraising. I think one way of reducing this confusion, I think, is that all investors need really to screen for ESG risks. I think that's become pretty much mainstream now. So whether you're an impact investor or just a financial investor, nobody wants to be exposed to those ESG risks. I think most investors realize that ESG risks rapidly become financial risks. And you see this particularly in regulations in the EU and elsewhere, that increasingly everybody is being required to address ESG risks. So I think that makes it clearer that when you talk about impact, you talk about going beyond that screening for ESG risks. So, the way I like to explain this is that ESG risks, you're looking at environmental, social, and governance issues which could affect the performance of the company, of your investments. When you're looking at impacts, you're looking at environmental, social, and governance matters which could affect the wider environment and society. So to take an example of climate change, if you're looking at climate risks in your company, then you could be exposed because of adverse weather events or other types of bad things that happen due to climate change. That would be material for your company. But you could also look at it the other way and say, how much CO2 is my company putting out? What is the climate footprint of my company? That would be looking at the impact of the company on climate. So I think they're two different lenses that you can bring to an investment strategy onto your appraisal of a company. And I think increasingly the ESG lens is really the basic hygiene that all investors need to do, and the impact is the going above and beyond that.
Thanks, Neil. I would like to invite for the next question Visa Lakshmi Chandramouli. Visa is the managing partner at Tata Healthcare Fund. Visa, over to you.
Yes, thank you, Neil. I think it's really good to hear some sharp insights from you. I saw in the presentation that you talked of some of the impact operating principles, right, for impact management. My question is there real evidence and data to say that if on the investing side, if a fund manager follows these operating principles, that there is indeed enhanced impact delivered? Anything that could shed light on that would be very valuable. Thank you.
Thanks. So the idea behind these principles is really to help asset owners and asset allocators to identify which funds and institutions to allocate money to if they have a strategy where they want to achieve impact. This brings a lot more transparency. So in two ways. Firstly, that just checking if a fund that you're interested in investing in is a signatory to the principles. You can easily go to the website and check that list as a first step. And we know that many institutional investors in North America and Europe are now doing that. And that's like a first question on their screening questionnaire is, are you following the operating principles for impact management? But it goes beyond that. You can then go and review the disclosure statement and really look at how a fund manager or an institution is managing in accordance with the principles. So there's a lot more transparency and disclosure, which helps investors better understand the different ways that the different funds are managing for impact. So we are seeing, increasingly, whether it's institutional investors or family offices, high net worth investors who have impact as part of their strategy, that they're using the operating principles as a way to screen and select investments. And just to add that, in the European Union now, there's a lot of developments in terms of classifying which funds are ESG funds and which are impact funds. And so, we hope that also the impact principles will become part of what is defined as being an impact fund. In fact, Germany recently passed a law which requires funds which use the impact label to be following the operating principles. And both in Europe and in North America, since the principles have come into the market, we've seen that a lot of the big asset managers have gone through and relabeled the funds that they offer to only use the impact label for those funds that are managing following the operating principles.
Thank you. That's very useful.
Thank you, Neil. The next question is from Milind Mungale, the Chief Impact Officer at Protean eGov Technologies. Milind? Can Milind unmute himself? Ravi, can you please check?
He might have dropped up, Neha.
Okay, I will just move on to the next question that I have from Vrinda Gupta. Vrinda is the consultant at E&Y. Vrinda, over to you. I hope the participants are able to unmute themselves. Okay, I'll just move on to Anna. I believe Anna here has a question that she would like to ask. So, Anna, go for it.
Hello, everyone. Hi, Anna Bruni. I'm the founder of The Confluencers. I consult for nonprofits. My question is, what do you think is the main driver that really incentivizes investment organizations to move across those different categories that you identified? Like if you're in the, I can't remember the names exactly, but if you're in the categories that are not impact, what motivates them to say, actually, you know what, this is a priority, I want to move? And generally, in your experience, just why do companies want to make this change? What motivates them?
That's a great question. In fact, I've spent a lot of time over the past 3 or 4 years having discussions with institutional investors around the world, insurance companies, pension funds, sovereign wealth funds and the like, exploring their appetite to move some of their portfolio. Usually it's not about getting investors to move their whole portfolio into impact. It's about saying, can you increase your allocation? Do you want to increase your allocation? And what we find when we have these conversations is that really in all parts of the world, large institutional investors are looking at increasing their allocations to impact. And what is driving that? I think it's being driven by their various stakeholders. It may be the pension holders, it may be investors, it may be governments, but increasingly people see that there's an inconsistency between investing, say, to provide pension benefits, if you're at the same time not investing in a way which produces a world that people want to live in when they retire. Or there's an inconsistency between managing a portfolio so that you can pay out on insurance claims, but at the same time not investing in a world which avoids damaging climate change, which is going to increase the need to pay out on investment claims. So I think more institutional investors see that it's important that they use their investment portfolios to actually help create a world which is aligned with the interests of their beneficiaries, whether it's insurance policy holders or pension recipients. And then you have more at the level of retail investors and high net worth and family offices. You've seen, I think, a generational shift as more of those assets are being managed by millennial and younger investors who have grown up with a heightened awareness of environmental and social problems. And so, we see, very much they want to see how they can use the capital, which they may have inherited, to do more than just make more money on the money they already have, but how they can actually use it to make a positive impact on the world. So these are some of the motivations that we see really driving the interest from the asset owners. And then in turn, because of this interest from asset owners, the large asset managers, the financial services providers and all the global capital markets are really responding to that. Whether you look at a BlackRock or an Apollo or any of the big global names in asset management, they're all building their capacity and staffing up to provide products to their clients which deliver impact, because they see that is where the market demand is growing.
Great, thank you, Neil. The next question is from the audience, which goes as it is. As in any large systemic change, there will be winners and losers. In your opinion, who amongst the different kind of investors in different geographies stand to win or lose in an era of impact capitalism? How are the investment professionals upskilling or preparing themselves for the imminent impact economy?
Yes, so as I say, I think that at the level of the financial services industry, I think many firms see this shift in the market and are staffing up and building capacity and developing systems so that they can respond to this market shift. So that the losers then will be the firms that are lagging behind in building those capacities. Increasingly, investors will want to work with asset managers and asset allocators who have the capacity to screen and manage for impact as well as for financial return. And then at the level of the companies looking for investment, I think that the ones that will lose are the ones that don't have good ESG risk management processes in place, which don't have a good story to tell about producing a positive impact for the world. We think they will find it harder to raise capital over time. At the moment, the amount of impact capital, as we saw, is a very small share of the market. So you don't really see that effect today, but over time, as more capital is invested to impact, it's going to, I think, be harder for companies that don't have a positive impact story to raise capital.
Excellent, thank you. I have a question here from Parul. She asks, mostly impact investments are available only for quantifiable goals. It's difficult to get investment for a long-term process-oriented work, especially for experimental grassroots level work. What is your opinion about that? And how can such initiatives attract investment?
Thanks. Yeah, it's a very good question. And I think the way I would answer that is to refer back to this idea that there's a spectrum of investment approaches all the way from grant giving through to fully commercial investments. And I think some of these more grassroots, innovative, experimental types of activity, you still need that capital that's sort of at the end of the spectrum, which is willing to either accept a lower return or be very patient capital and be prepared to wait a long time for a return, or be more tolerant of higher risk. And I think that one of the important different features of the way impact investors invest is that they often are more patient capital, are willing to invest with a longer time horizon. I've seen, for example, our average equity holding period is 8 years, which is longer than a typical private equity investor, and we will lend debt for 15, even 20 years. And that allows us to invest in opportunities which other investors might miss. So I think there's very much a need for investors who are willing to be patient, who are willing to take greater risk, who are willing to support innovation. And I think you will find that kind of capital from high net worth investors and from foundations and endowments. There was a time when foundations used to think, well, I have my endowments, which I have to manage for financial return, and then I have my grant giving corpus, which I just give away. I think now there are more foundations who realize that there's a spectrum of approaches and use their capital more flexibly. And I think that's going to be a growing trend. And so that kind of capital will be very useful for these kind of grassroots, seed, early stage, innovative types of investment.
That's great. Thanks, Neil. The next question for you is, what is the correct timing for a privately held VC or PE funded company to undertake ESG, sustainability, or impact assessments? If this is not required by the law or by investors, then what is the right motivation? For example, fundraising or risk management that should indicate to the founder or CEO that the time is right to undertake this and that it won't be an indulgence?
So I would say that I don't think it's ever going to be an indulgence. I think it's more about needing to scale the cost of these activities with the size of the company. But I think that building good ESG risk management into the company from the start is going to serve the company well as it grows. And thinking about how you want to position the company and what kind of impact objectives you have in your corporate strategy is something you probably want to do from the earlier stages. Now, you may not be able to put a lot of resources into ESG measurement and impact reporting when you start, but at least having that clear understanding of how you want to position the company and how you want to build those systems will be helpful when you are approaching investors who increasingly are going to ask questions about that. And you see increasingly in Europe and North America and elsewhere that companies are starting out as B corporations or other types of legal form which allow them to pursue impact. So it's really sort of baked into the corporate structure from the start, and I think that gives a good foundation for many companies.
Great. The next question is from Milind, and he says, the transformation processes post a comprehensive impact assessment. How are impact targets getting embedded in the leadership KPIs? Are CSR, ESG, sustainability, and impact teams merging? Are there insights on how organizations are internalizing these movements? And what role do you see for a chief impact officer?
That's a lot of questions there. Let me see. I can answer at least some of them. So I think you are seeing more management teams using impact and ESG metrics as part of incentive frameworks. Likewise, you're seeing in fund structures, you're seeing more use of impact and ESG targets as part of the compensation framework for how fund managers get compensated. And all of that, I think, is good, because once you start using these metrics for management and linking them to rewards and incentives, then that creates the right incentive for people to take the data measurement and the data quality very seriously. I think there was a risk that when you're just using ESG and impact reporting as something you put in an impact report and you feel, well, it's for outside stakeholders and it's for marketing, that maybe internally you don't always take the quality and the precision of those numbers seriously. Once it's linked to your actual management KPIs, your investor compensation, then I think it helps people take those numbers very seriously and improves the quality of the reporting. So I think that is something that we're seeing more of. But the other thing I would say about this is that I think fundamentally what is important is that there is good alignment between the business KPIs and the impact KPIs. That impact is not like social responsibility, that it's like a side activity that you do that isn't aligned with your core business. That the way you can successfully achieve impact is where it's really aligned with the business strategy of the company, so that if you're successful on your business KPIs, you're also going to be successful on your impact KPIs.
Thank you. I have a question here from Vrinda. Given the proliferation of standards and frameworks for ESG impact measurement and management around the world, there is no easy way to compare one organization or fund with another. Aspire is leading impact assessments and ratings to enable comparison of funds, companies, and industries at an aggregate level. How far are we from true global standardization, and how are the investors and corporations expected to behave in the interim?
No, it's an important question, and I agree it's been a very confusing world to navigate. There have been lots of different standards and frameworks, but I guess I'm quite optimistic now. I do see some momentum towards convergence and alignment of these various frameworks. I think it was very significant that the G20 came together late last year and supported the creation of the International Sustainability Standards Board. So just as in the world of financial accounting, you have the International Accounting Standards Board, which is really aligned reporting standards around the world for financial reporting. Now we're at the beginning of a process for creating the set of international sustainability reporting standards with an International Sustainability Standards Board. And so that is just starting work this year. They're appointing board members, and they're starting with work on agreeing standard reporting for climate impacts is the place where they're going to start. And clearly it will take some years for them to build this out across the full range of environmental and social impacts. But I think that is an important first step in the direction of harmonization. I think the second thing which gives me optimism is the work that's being done in the European Union now in terms of creating first the green taxonomy and then a social taxonomy. Now there's been a lot of controversy and debate about what should be in or what should be out of those taxonomies, but it's really getting everybody's attention, and people are doing the hard work of hammering out agreements on what should count as green, what should count as social. At the same time, the regulations which are requiring more clarity in the market and labeling of funds between what's an ESG fund and what's an impact fund. So I think between the work that's going on in the EU and then the global progress towards international sustainability standards, I think we will be moving away from this world of overlapping and confusing metrics towards greater standardization in the next few years. Thanks,
Neil. The next question is from Naveen Gautam. He's here in the audience, the MD of Hella India. Is there any incentive in terms of preferential status as investor from certain countries based on impact initiatives or ESG priorities?
I'm not quite sure I understand what Nathan is thinking of in terms of preferential status. Maybe you can clarify.
All right, so evidencing and measuring impact are controversial and fast developing areas likely to...
I think, Neil, the intent of that question appears to be that if a company is undertaking regular ESGs or impact assessments, would they be seen preferentially by investors going forward, or by certain countries who are more committed to it, or not?
Okay, I get the question now. So I think it's more that companies that pay attention and provide transparent reporting on impact will attract a wider range of investors than otherwise. I think it in terms of countries, I think if you're looking to raise capital from within the European Union, then being able to report against these emerging regulations and taxonomies in the European Union is going to be very helpful. So in terms of countries, I think the EU with a group of countries is where this is, makes the biggest difference.
Okay, thank you. I think we have another one question that we can take today. So this is tech for good companies like fintech, agri-tech, ed-tech, clean tech, health tech, etc. are having disproportionate impact with respect to the size and investments in a post-pandemic world, especially when compared to old world brick and mortar type companies. Is there a risk of apparent congruence between investment and impact, which pits the old order versus the new economy in an era of impact capitalism, which will become hard to address or resolve?
So yeah, I think there's a huge amount of activity with the application of technology in various business areas, which can have positive impacts. I think we've seen a lot of impact investor interest in financial inclusion, in clean tech, increasingly post-pandemic, in ed tech and health tech. So I think these are really industries which are at the top of the list of being of interest to impact investors. But I think it is true that there is still large capital needs to invest in older sort of bricks and mortar type industries, particularly in providing infrastructure. It's hard for you to deliver on all these great technological services if you don't have good broadband infrastructure, if you don't have good electricity provision and all the supporting physical infrastructure as well. So I think there is also going to be attention from impact investors will continue to invest, particularly in sustainable infrastructure. I think is going to be an area that will attract a lot of impact capital, and we're also seeing a lot of interest in affordable and sustainable housing, particularly in the many emerging markets. There's huge unmet needs for housing, and the housing stock that exists, it may not have good environmental standards, may not be energy efficient. It may be in areas that are at risk because of climate change. So I think a lot of excitement and impact investing around the various impact tech opportunities, but there are also still important opportunities in building the hard infrastructure of housing and providing telecoms infrastructure and things like that.
Thank you very much, Neil. I will now invite Amit Bhatia to raise a word of thanks, and I will be back after that. Amit.
Thank you, Neha. And thank you so much, Neil. Thank you so much getting up early your day and to address our colleagues here in India. It was a treat to have you with us. You answered dozens of questions, and I know I'm getting several more questions, which we unfortunately cannot get to you within this 1 hour. We are 5 minutes to close. But listen, it was genuinely a real treat to have you here, and I hope in the months or years ahead we get a chance to physically host you here again, and and hopefully as you up the ante on academics and teaching, because this is going to be an area in great demand, and you have just absolutely a truly enviable credentials global in ESG sustainability impact. So thank you very much for being with us, and I'll let Neha close this meeting for us. But thank you, Neil.
Thank you. It's really been a pleasure, and look forward to my next visit to India.
Absolutely.
Thank you, Neil. It has been a wonderful session, and it has been wonderful listening to you as well. We will have a couple sessions this year as a part of our larger initiative towards a joint impact future, and we look forward to seeing all of you there. So on behalf of Aspire, I would like to thank you all for your time today, and especially Neil, heartfelt thanks for your early morning. Here is a video highlighting our compelling joint impact future. Thank you very much for joining. We will close the session today, but we will be back with other masterclasses soon. Have a wonderful day ahead.
Thank you all for joining. Thank you, Neil, and goodbye, everyone. Goodbye.
Thank you.